Hello and welcome to another financial analysis video with myself, Moeed Amin, and Ted Wayman. Today we're going to be looking at PayPal. Now, the purpose of this show is to help you. It's an education show and it's to help you raise your business acumen. And one of the best ways to do that is to be able to understand the language of finance. As Warren Buffett said, if you want to be in business, you need to understand its language, and finance is the language. And we do that by helping you read and analyze financial statements from famous, well-known businesses, which is why we're looking at PayPal today. So we're going to look at the backward-looking annual report and the financial, specifically the financial statement, but a bit of context around PayPal and what they do. They're obviously a very, very well-known company. They're involved in online payment systems, so they make it easy for you to transfer money, to pay someone, to receive payment from someone, much more easily without having to input your financial details every time, which is what we currently had to do. And back then, that was the only method of doing so. They also disrupted the checking and wire transfer methods, which were quite expensive at the time, and they essentially almost made it free for people to use. So they were a very, very big disruptor. Now, a couple of things to note about the business. Actually, there's a misconception that Elon Musk founded this company. That's actually not true. It was originally a company called Confetti, which was founded by three people, two of whom were Peter Thiel and Max Levchin, quite well known in Silicon Valley. They then merged with a company called X.com, which was founded by Elon Musk and one other person. And Elon Musk believed in the model of what Confetti at the time were doing in terms of financial transfers, bank transfers, etc., that he decided to shut down essentially most of the, or if not all the products that X.com were doing and focus really on PayPal. But soon after that, he was replaced by Peter Thiel as the CEO of the company, which then became PayPal. So interesting points to note, not hugely important to the financial statement, but I thought that was quite interesting there. We're also going to look at the share price later, so stick around for that towards the end, because that share price and in context with the financial statement gives you a very complete picture. So whether you're involved in selling services to a company like PayPal or investing in them, or thinking about joining them and want to sound smart and have knowledge about the company, then this is going to be really important. So stick around. What I'll talk about though now is if you invested in 2015, which is when they IPO'd, you'd be sitting on an increase of about 157%. Not as high as other technology-based businesses that we've looked at, where their increases have been in the thousands of percent. So they've had a bit of a rough ride recently, actually. So in the last 5 years, you'd be sitting on an increase of 25%. And in the last year, you'd be sitting on a decrease of around 63%. So it's definitely dropped quite a lot since its high price points just after the COVID pandemic. So stick around, we're going to talk about that in more detail. So I'll transfer over to Ted, and he will walk you all through the finances and how to analyze the finances of a company like this and draw some conclusions.
Good to see you, Moeed. Thank you very much, and welcome back to all of our subscribers, or welcome if you are new to the channel. And if you are new, please do hit the subscribe button in the bottom, I think it's bottom left-hand corner of your screen. So remember to like, share and subscribe. And if you do like, share and subscribe, not only can you ask us for additional analysis, and this particular video is the result of two of our viewers asking for us to have a look at PayPal. So Senk and Carly, here is your video. And obviously, if you are subscribed, then you will get notification of when new videos come up. So with that in mind, let's jump straight in and have a look at the financial statements. So here they are. This is the 2021 annual report. There it is, and it's kind of talking about the 2022 AGM. So we're looking at the 2021 annual report. This is available on their website, so relatively easy to find. Very glossy document with who they are, what they do, and all the details and the strategy, etc., etc., of the organization as standard. And we are interested in the financial statements, so we're going to whiz all the way through the detail of the what the company's up to, and really focus on the actual numbers. Now you'll notice that we actually have to go quite a long way in order to find the numbers. So you'll see that we're having to go all the way through to page 160 out of 216. So often you find in these annual reports that there's a lot of information about the company beforehand before you get anywhere close to the actual numbers. So we are in dollars, we are in millions of dollars. So the revenue for these guys, that's the turnover or the sales, 25,000 million, about $25 billion. So just over $25 billion, and fairly substantial rise, 18% increase on the previous year, which again is a substantial increase on the year before that. So these guys are there's a meteoric rise going up. Now, the way they present this is quite an interesting one, because these guys are effectively they're a fintech company, but they are very much presented as a as a company rather than a financial services company. So they have the transaction expense, so the cost to them of actually generating these fees, and there's additional credit losses. So this will be people who have borrowed money from PayPal, and then PayPal credit cards, for example, and then have just done a run and not paid them. And so I've decided that these two are your cost of sales. This is the cost of doing business. This is the cost for the company to do business, and in effect, if you take that as a cost of sales, it gives them a gross profit margin of about 55%, just over 50%. So it's basically saying every dollar they make in revenue, it's costing them, in terms of transaction expense and credit losses, it's costing them 45p or 45 cents for every dollar, and they get to keep 55 cents. They've then got all the costs of running the business, so they've got all the cost to customer support and operations, sales and marketing, technology and development, and then all the the usual general administrative charges you find in any organization, such as rent, rate, light, heat, HR, finance, facilities, etc., 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 and a bit of restructuring as well, which is another word for redundancy. So that leaves them with an operating income of about 4.3 billion, which is a 17% margin. So for every dollar they're charging, they're getting to keep 17%. No interest, you'll notice, no interest. So there's no debt financing this company. And for some reason, they get a tax refund. I'm not sure quite how they ended up with a tax refund in this particular year. Usually you'd expect a tax charge like in previous years. So that's a little bit of a funny, but that's usually probably more of a one-off than anything else. But, either way, their bottom line net profit, 4.2 billion, compared with the previous year of again 4.2 billion. So pretty consistent in terms of their profit figure down the bottom. 16% this year, 20% in the previous year. So pretty profitable company, looking good. Let's have a look at their balance sheet. And on the balance sheet, we see the assets and the liabilities. So in terms of their assets, these two numbers, this is the cash sitting there. So they've actually got physical cash, 5 billion, plus short-term investments, which is where they can park cash in the interim. And then you'll also notice that they have funds receivable and customer accounts. So this is the money that's owned by the customers sitting on their balance sheet. And we'd expect that to be matched to what they owe back to their customers, which is effectively here. So those two numbers match off against each other. It's not that they have to pay them, but for example, if you've got money in your account with PayPal is showing it as both as an asset of the business, but also an amount owed back to you. What else have we got going on? so that's really their kind of their big assets. A few loans as well. Those would be the kind of the credit cards, for example, we were talking about. And then in terms of their non-current assets, they've got a whole lot of goodwill. So as Moeed was saying, they've grown through sort of mergers and acquisitions, for example. Some long-term investments. Again, we could probably treat that a little bit like cash. It's just kind of parking long-term cash. Little bit of property, plant and equipment, not a huge amount, and then a few other bits and pieces. That intangible asset will probably be software development costs, for example. So about 76 billion in total of assets, being 52 billion of current assets and 23 billion of non-current assets. On the liability side, little bit of debt there, quite interesting. So suggesting, I did mention that there was no debt on this company. So if we go back to the income statement, what we'll probably find is that this other income expense net, this number here is effectively the interest that they are receiving less the interest that they are paying. So this is a small interest expense. It's a relatively small amount, because they have a lot of money on deposit as well, which effectively offsets that debt. So they do have some debt, which we didn't pick up on the front page of the income statement. No other real liabilities, and really the big liability for these guys is the kind of the funds, your funds, which are held in your PayPal account. So net assets, which is the same as the equity in this business, is 21 billion, or $22 billion, 21,727, which in theory, and I mentioned the word theory, says that if you take all the assets and then you pay off the liabilities, you're left with about 21 billion. So this is known as the book value, or the net book value of the business. This is made up of, you'll notice that we got quite a lot of additional paid in capital by the shareholders. Here's the retained earnings, but we need to read that retained earnings in line with this line here, this treasury stock. So treasury stock is own shares held. So in effect, what these guys have done is they've made $16.5 billion in profits, but they've used 11.9 billion to buy back their own shares. So treasury stock, if they buy shares in another company, it'll appear as assets in the balance sheet as investments. But if they buy shares in themselves, they can't invest in their own in themselves, and therefore they show it as a reduction in what they owe to the shareholders. So again, share buybacks, another way of returning money to the shareholders, but returning money through capital growth rather than through dividend income. So there's our balance sheet. Profit and loss account, we've had a look at the movement in equity. Here's our movement in equity. So retained earnings, this column up here, there is, we just see the net income, which is the profit figure coming through. That was a couple of years ago. Here's the profit figure for last year and the profit figure for this year. So what we can see here is that basically these guys are not paying any dividends. However, what they are doing is they are buying back the shares. Now, sometimes a company will show that treasury stock buyback through the retained earnings. These guys have actually got a separate account for it. And so in effect, we really need to be kind of matching. Here's the profit they're making and then the share buyback that they're making. That's a couple of years ago. Once again, last year, the profit compared with the share buyback, and the year under examination 2021, the profit and the share buyback. So these guys are doing share buybacks, and we need to sort of think about those share buybacks when we're thinking about the return to the shareholders. The share buybacks, as we mentioned, is another way of a company returning money to its shareholders. Final one is our cash flow, and the cash flow shows the cash provided by operating activities. Now, again, these guys, this is a cash company, so we need to be careful when we look at a company like this. If we're looking at someone like Coca-Cola, for example, they would be raising cash to buy assets in order to make make their product in order to sell the cash, whereas these guys are affecting using cash. They sell cash. That's basically what they do. They sell cash services. So the cash flow statement isn't quite so relevant for these guys, but we'll look at it anyway. It says that they're generating lots of cash. That's good. In terms of their investment, we've got, this is the purchase of securities and the maturities. So this is kind of parking cash and taking cash out. We probably need to read those two numbers together. You'll notice that they're big numbers and they're pretty similar each year. So this is just putting money on deposit and taking it off deposit effectively. There's a little bit of investment in property, plant and equipment, and a little bit of acquiring other businesses. And again, that goodwill will arise because PayPal is growing by buying other organizations as well. I think they own Venmo, for example, although I may be wrong on that. I'm sure somebody will pick me up in the comments. So please, if I am wrong, leave a comment, but do be polite. And then the last section of the cash flow is the investing activities. So here is the purchase of treasury stock. That's effectively their kind of equivalent of a dividend. And we've got some other bits and pieces, funds payable and amounts due to customers. That looks to me like an increase in deposits, for example. Increase in deposits, which is effectively funding the organization. So lots of cash, basically. So cash at the end of the period, they've got 18 billion sitting on the balance sheet in cash, 18 billion at the beginning of the year, at the end of last year, 18 billion at the beginning of end of this year. So lots and lots of cash. So really very, very strong profit and loss account. So this is very, very profitable. There's a little bit of debt, but the debt isn't an issue. The sort of if we want to look at liquidity ratios, it's absolutely fine. These guys have got they're ticking lots of boxes. Very, very, very strong. A very strong business. So in terms of lifting the lid and looking under the bonnet and seeing how they performed in the past, really there's no gremlins there at all. Obviously we've been talking about the share price before, Moeed, and the share price is really focusing on the future rather than the end. This is quite an interesting one. A market cap is just over 100 billion. So remember that the net book value is about 22 billion. So you're paying about nearly 80 billion more than it's worth, and that would be effectively what's called goodwill. So if you were to buy PayPal, if you were to set up a company and buy PayPal for 100 billion and you get 20 billion of net assets, the difference is the goodwill, and represents the ability of this company to make money, the strength of the brand, processes, etc., etc., etc. So these guys are, they're highly valued. The PE ratio, quite interesting. This PE ratio, quite not sure exactly where that one comes from, because by my calculation, if you're making a 4 billion profit, which they did in 2021, then the PE ratio is about 25 times earnings, not 50 times earnings. So that may be that there's that's based on a half-year update or sort of more recent set of numbers, which would suggest that maybe their profitability is has fallen a little bit. But PayPal is, they're going to be around, and don't forget this high price that we're seeing here. This is very much due all to sort of expectations. So when we see the price kind of going up, that's not sort of necessarily the actual figures coming through. That's just saying, look, the company, the potential for this organization to really generate future revenue, future profits is very, very high. We can see there's the pandemic, little dip in the pandemic, and then everybody's going online, and basically everyone's buying anything which is in an online space. And then reality hits, and there's a sort of a big correction. So we're kind of back to what we call head and shoulders here. So there's a kind of, we go all the way up and all the way back down again. So if you ignore that kind of that blip there, and your chart might kind of put something along there suggesting maybe it's a sort of it's reasonably priced compared with where it's been in the past. I don't know, it looks expensive to me. It certainly doesn't look cheap. I don't know whether PayPal's business is designed for high interest rates. You know, banks, for example, will make much more money in a high interest rate environment rather than a low interest rate environment, because it's the difference between what they charge people to borrow money from them and what they pay people to deposit money them. And you know, in a world of high interest rates, that you know, that gap could be much higher. So banks can make money in high interest rates. Can PayPal make? I don't know whether they're kind of they're inflation proof perhaps, or that they would thrive in a high interest rate environment. You know, certainly they'll be able to charge higher fees on their credit cards, for example. But you know, I don't know. So there we go, Moeed. You know, that's my kind of analysis of PayPal. You know, it looks a pretty strong company. You know, there's no gremlins there, but you are buying very much. You know, I can't see it sort of, you know, falling over. But you are buying something. You know, the future potential, and you know, it's a competitive space. Lots of people are moving into that space. And so, you know, it's your assessment as to the future strategy of the company, and whether they are going to deliver on that strategy and deliver the value that looks like being baked into the share price at the moment.
Yeah, and so there you have it. Recommend that you look at a couple of other videos that we've done within this space. We have looked at Stripe, so you can search for that. And we've also looked at a few banks as well. So Lloyd's Banking, I believe we looked at Barclays as well, and a few others. So you can certainly search for those videos, and we'll add a couple here for you to be able to quickly click into. But until then, do leave a note in the comment section. As Ted said, if you have a company that you're really interested in and you would like us to analyze the finances for you, do leave a note in the comment section and put some context behind that. The more interesting the context, the higher likelihood you're going to be pushed up the priority ladder. So until the next video, thank you, Ted. Thank you, everyone else.
No worries, Moeed. Catch you later.